In this session, we will be discussing the vector autoregressive model, which is a crucial concept that is highly relevant to our time series analysis section.
Following our standard procedure, we're now going to take the Finance Research Kit and apply its principles to a concrete numerical example. However, before we dive into that, it's important to provide a brief overview and some essential background information regarding the value at risk, or VAR.
For this particular example, we will be utilizing three distinct variables. These variables are considered at the time series level, which essentially means we'll be working with the aggregate data. Our first key variable that we'll examine is the payout yield, which we'll refer to as V, in this context also known as the payout yield. This payout yield is simply calculated by taking the total cash flow distribution paid out by the company and then dividing that by its current market value.
And that will be at the market level, meaning it applies to all companies operating within that market. We are simply referring to the fundamental ratio that defines how financial payments are distributed to the company's valued shareholders, considering various methods, whether these involve direct cash distributions, the regular issuance of dividends, or even strategic stock repurchase programs.
That represents the total yield that will be given to the investor.
The other important variable is the rate of return,
which is the annual stock rate of return for the entire market, a key indicator reflecting the collective performance of all firms. And finally, we are going to incorporate the growth rate in cash flow, which offers valuable insights into a company's financial health and its potential for future expansion. To determine the growth rate of the aggregate cash flow, we must first identify the total cash distribution made by all companies within the market during period T. Then we calculate this as a ratio compared to the amount from the preceding period, and finally we apply the logarithm. What we're looking for here is essentially the percentage change in the overall growth rate. It's crucial to understand that we're calculating the percentage change in that growth rate and not simply the numerical difference, but rather the actual percentage change itself. Or more specifically, the growth rate of the total aggregate financial payouts. These are the three distinct variables that we will carefully proceed to sort and subsequently organize into a single vector, which we will designate as x.
So x isn't just one variable, it actually has three separate variables. These include the overall return and specifically the stock return, the rate at which the cash flow is growing, or perhaps I should clarify my previous statement. I mean the actual cash distribution. That term is certainly more precise and accurate than simply referring to it as cash flow. And finally, the last point to consider is the payout yield. Now, when we're operating within the VR system, our methodology dictates that we will be utilizing the lag values of each individual variable specifically for the purpose of explaining and predicting the subsequent periods level for every single variable. Consequently, by the time we arrive at the final outcome, the result we anticipate obtaining should bear a very strong resemblance to this particular example. In order for the return equation to properly function and include a constant term, we consider the lagged value of the return itself as the primary independent variable. Additionally, we also incorporate the lagged growth rate in cash flow. So this particular concept would be denoted as G, or alternatively, in some specific cases, we will represent it as a change in cash. It's important to remember that these two expressions are essentially the same. And as a third variable, which is able to explain the subsequent period's rate of return, we have the logged level of the payout yield. Similarly, for the cash flow analysis, we are going to employ the very same three variables, but in their lagged form. This is precisely the reason we're utilizing a vector autoregressive model. This implies that we're not just incorporating a single variable for the autoregressive component, but rather we are considering multiple variables. So, the mathematical framework we're examining here essentially refers to the transition matrix, and it explains how we effectively utilize the current level of our previously observed or lagged variables in conjunction with that very same transition matrix to accurately determine and compute the anticipated or expected values. So, for example, if we were to consider these numbers, let's consider the annual return, which is set at 8%. Then we have the growth rate for the cash flow, which comes in at 3%. Additionally, the payout yield, when expressed in its logarithmic form, is negative 3.2. This particular value, in fact, directly correlates to a 4% growth rate in the overall cash distribution. If you were to consider these as an xt variable at this particular point in time, and your objective is to accurately forecast the corresponding values for the subsequent period, then it becomes absolutely necessary for us to acquire the appropriate transition matrix. This crucial matrix will be readily available to us once we successfully execute the VAR technique. This matrix is going to clearly show you the effect of each variable. For example, when we consider the overall rate of return, the statistical coefficient, which measures the persistence effect stemming from the previous period's lagged return, is found to be precisely 0.1. So the higher the lagged return, the higher the next period rate of return, and the connection between them is 0.1. Furthermore, the growth trajectory of cash flow plays a crucial role. A more substantial and accelerated increase in cash flow would directly lead to a significantly higher rate of return. This relationship is quite logical and makes perfect sense. Finally, we must consider the lagged level of the payout yield, a crucial indicator. This, in turn, will also lead to a significant increase in the subsequent period's rate of return.
So what we're observing here are the numerical coefficients that correspond to each of our independent variables, which collectively form what we refer to as the x vector in our model. And then moving on to the structure of this data, for the very first row within this entire setup, its specific purpose is to capture and represent the calculated rate of return.
Now, for the second row, this particular entry corresponds to the second variable, which specifically represents the growth rate of the cash flow.
Or the cash distribution.
Therefore, a more substantial rate of financial return is expected to accurately forecast a more significant increase in the subsequent period's cash flow, or indeed the overall growth rate of cash distributions. The specific level of its lag or the degree of its delay actually has a more pronounced and positive effect. Additionally, a more substantial payout yield observed during the most recent reporting period serves as a reliable predictor for a more accelerated growth rate in the overall cash distribution. And finally, let's consider the last remaining element in this series.
Let's look at the very last row on our table here. This particular metric is dedicated to the payout yield. A significantly higher payout yield that was observed in the previous reporting period will often predict a subsequent decline. This is primarily because the company might not be financially capable of sustaining such an elevated payout yield indefinitely. I must emphasize once more that all of these figures we are discussing are purely hypothetical numbers.
The 5% represents a measured effect, which is attributed to the delayed growth rate in the distribution of cash.
A notably higher growth rate in the distribution of cash is a strong indicator that we can anticipate a significant increase in the payout yield for the next fiscal period. Given that the company will possess greater financial resources, it will therefore have an increased capacity to distribute more cash to its shareholders when compared to its overall market value of equity, which ultimately translates to a higher payout yield.
And the payout yield, specifically considering its lagged level and its autoregressive component, is demonstrating a very high degree of persistence. Consequently, the current valuation itself is quite persistent, given that the estimated coefficient for this particular factor is precisely 0.8. It's quite common for firms to try and smooth out, maintaining a consistent level of payout yield across different time periods. This particular behavior could very well explain why we're observing such a high coefficient in this instance. Alright, so let's go ahead and apply this particular concept that we've just learned by using the Finance Research Get. Specifically, I'm going to be working with the available time series data for our analysis. Then from those options, I'm going to proceed and select the annual data frequency. And once that's chosen, I'll then proceed to apply all of these settings. Alright, so we'll need to configure the settings for our annual data analysis. We'll start gathering data from the year 2000 just to make absolutely sure that we have all relevant firms available, and then we'll conclude our data collection in the year 2024. The primary reason we chose to avoid including data for the year 2025 is simply that not every single firm had provided their complete 2025 data by the specific point in time when we were recording this particular video. However, for 2024, we are fortunate to have all the necessary firm data readily available to us. It's only then that we can proceed with our analysis and apply our methodology.
During the initial few years, we need to obtain.
Let's consider the overall annual rate of return. So if you recall what we just saw, the very first variable is the annual rate of return. So I'm going to select.
Regarding the annual return, it is imperative that we accurately determine the market value weighted annual rate of return and not the sample equally weighted one.
If you want to apply an equal weighting to your data, you can simply keep the aggregation method as the mean, because the mean in this context represents an equally weighted average number. The annual return is provided individually for each firm, so the main question we need to address is how we can aggregate that data across all firms for every single year. The specific aggregation method we choose will provide the answer to this important question. I'm going to use the evaluated Leaving these selection boxes empty by default means we're automatically including all available firms. Then we apply the necessary filters.
We should officially call that the annual return. It's already in existence.
Okay, that's perfect. However, the variable wasn't actually computed, and that's because we hadn't yet selected the appropriate weight column. So our next step is to weight this particular variable by its market value. So with that in mind, let's go ahead and search for the market equity.
Market equity is essentially the market value for each firm.
And then we are going to have the annual return calculated after successfully determining the appropriate weighting factor, which is essential for ascertaining the market value or the adjusted valuation. We successfully acquired the annual return data, which was meticulously calculated and evaluated for each fiscal year. Furthermore, another significant variable that we took into consideration was the percentage growth rate observed in the company's cash flow. At this moment, we don't have the necessary cash flow available, but we do possess all the required components. Therefore, we will proceed to activate this particular section. How can we obtain the necessary cash flow?
You see, this particular one we're looking at, it's exactly the same as the payout yield.
This particular metric is then multiplied by the overall market value of the company's outstanding equity. The fundamental reason for this calculation is quite straightforward. The payout yield is simply the total cash distribution that's provided, then divided by the current market value. And if you consider this specific ratio and multiply it by the current market value, you will then be able to determine the total amount of cash flow. Now, we don't have the exact amount of cash flow readily available here, but we can certainly derive it. So we're going to proceed and apply this specific equation. Then we'll multiply the payout yield.
It's based on the total value of the company's market equity.
So, by multiplying A with B, we can effectively calculate the cash flow. And then, after we've determined this value for every single firm, it becomes necessary to aggregate all of these results since we're dealing with a time series page. The aggregation method we'll use is summation, because we need to obtain the total aggregated sum of cash flow across all the different firms for each individual year. We'll then refer to this as the aggregate cash flow.
Or I'm going to have to make use of the distribution.
We're talking about the actual cash that is being spent, not necessarily focusing on the cash flow that's generated directly from the core operations of the company itself. Anyway, and then once that's clear, we are going to apply our analysis. And of course, for this particular step, we'll be selecting all available firms by default.
And to ensure we're all on the same page, let's reiterate and formally designate this specific amount as aggregate cash. And then we're going to proceed to find the last remaining variable.
The payout yield. The specific data regarding the payout yield, which we've been discussing, is now fully available for your review and analysis.
We have decided not to proceed with the equal weighting approach for this particular strategy. Our primary objective is to align ourselves with the established and widely accepted major mainstream methodologies prevalent within the field of finance. Instead, our intention is to implement and apply a value-weighted methodology. However, we want to make it absolutely clear that the final decision rests entirely with you if you prefer to utilize the equal weighted approach. You should proceed with the application of this method. At the very beginning of this process, the system will not continue to move forward with your submitted request because it will prompt you to provide a clear definition for the specific weighting factor. For our purposes, we have decided that we will be utilizing the current market value as a designated weighting parameter. And we're completely ready. If we just give it a little bit more time, then we should certainly be able to have all three of those variables calculated within the context of our example. So if we're looking at the overall aggregated, or perhaps more specifically the annual stock market return for the entire market, then we consider the total aggregated cash flow generated by these companies. And finally, we also take into account the crucial metric known as the payout yield.
Now, the primary variable that we are truly interested in here is not just the aggregated cash flow itself, but rather is the actual growth rate we observe within that aggregated cash flow. So we absolutely must determine and find that. To do this, let's derive a new series using this box. We will then apply the time series transform. And then let's now make our final selection for the aggregate cash distribution.
And then let's find the percentage change as a transformation method. And let's call this growth rate cash.
And then let's proceed with the creation of the series.
Now we have obtained all the necessary variables pertinent to our VAR estimation. Let's scroll down to the very end of this.
Okay, let's go ahead and apply the VR model to this analysis. It doesn't seem to be immediately visible on the screen, so we'll need to scroll further down the page to locate it. There, we'll find the multivariate version, which is the VR. Now, let's proceed to select all the variables from our vector. These include first, the annual return, second, the growth rate, and finally, the payout yield.
Regarding the number of lags we require, given that we are exclusively working with annual data, we are confident that a single one-year gap will be entirely sufficient. Therefore, our approach will be to utilize just one lag.
We'll define the residuals from our vector autoregression model as the innovation. This signifies an element that is entirely unexpected given the established framework of the model.
And then we are going to proceed with fitting the VAR. Give it a little moment.
Here we are presented with the overall outcome of our model. Therefore, we have established three separate equations. Considering that we are working with three distinct variables. Regarding the equation that specifically determines the annual return, these particular values represent its coefficients.
It's clear that none of these coefficients are statistically significant, and they actually correspond to this particular form.
The return is a function of a constant factor, which means the annual return is primarily explained by a constant baseline and by innovation. The time lag does exhibit an effect, however, its overall impact may not be statistically significant because the t-value associated with this particular effect is not significant. Similarly, the observed growth rate pertaining to the cash distribution of these assets is not considered to be particularly significant, and the same conclusion applies to the overall payout yield as well. For the second equation, the cash flow, or alternatively, the cash distribution growth, is essentially a function of a constant term and those very same lagged variables. You'll need to go back to this specific point to find the growth rate information. Pause. Additionally, it's important to observe that none of these particular coefficients are statistically significant. However, when we examine the electronic payout yield, the only statistically significant coefficient is the lagged one, since firms typically demonstrate a strong tendency to maintain a consistent payout yield over time.
So the lag would be highly relevant as a factor in explaining the next period payout yield.
Down here, we're looking at the correlation matrix of the residuals, or what we often refer to as the innovation, showing how these innovations correlate with each other. For example, let's consider the innovation in annual return. This particular section focuses on how that is interconnected with the innovative aspects of the cash flow, the cash distribution growth rate, and how it also connects with the innovative patterns in the payout yield.
So we are specifically talking about the correlation between these error terms.
And what we can clearly see from our data is that there is a significant correlation present within the area of innovation. For example, when we examine the connection between innovation and the annual financial return, and also the corresponding growth rate in terms of cash distribution, we observe that it is indeed negative. So, for instance, if there's a positive shock, like an unexpected boost to the annual return, this is typically associated with a corresponding negative shock or a reduction in the growth rate of cash distribution. Essentially, these two factors tend to move in opposing directions, and we observe the very same pattern when we consider the payout yield as well. A higher degree of annual return innovation is typically associated with a correspondingly lower level of payout yield innovation.
Now, if you scroll down, we can clearly observe the comparison between the actual data, which is somewhat more erratic, and the fitted one. It appears quite evident that the model is successfully capturing the overall trend and the fundamental pattern of the data. For example, if we look at this particular point where there's a clear decline, the model accurately shows that same downward movement. Subsequently, in this next section, we can clearly observe a noticeable, albeit small, increase. And then as we move to this final segment, the values remain almost entirely stable, showing very little change.
So the overall trend and the general direction of the data are captured quite effectively by the model. However, the model is clearly failing to accurately capture those sudden spikes, those quick, rapid movements.
So it seems the variable's movement is much higher than what the VAR implies.
This is the primary reason why the VAR system is employed to identify and capture the innovation, and that innovation can then be utilized in other analytical processes. So, what we're looking at here, these residuals, they represent the truly innovative part. This particular aspect can then be effectively utilized, for instance, in the field of empirical asset pricing. And the reason for this is that we have carefully filtered out any underlying trends or various components that might typically be found within, let's say, the annual return.
So, what we're ultimately left with at this point in time is
What we are left with is simply the portion that remains unexplained. This, it could, or rather, it can certainly be attributed to various crisis events, or perhaps to some unique idiosyncratic factors. Following this, we can then proceed to utilize this innovation within a subsequent analytical review.
So this figure is related to the primary subject we've been examining.
The annual rate of return. So to double check this, we can refer to the information above, and you'll see that it's quite similar to what we already have.
At this moment, we're holding on to this new innovation, so we can effectively utilize it right here.
and then naturally we'll have the ability to save the image.
Furthermore, the innovation that has been preserved can then be applied to all of the following sections. For example, right here, look.
That is provided to us, and it's also crucial for any analysis that follows. We can use it in regression modeling, predictive forecasting, and many other related fields.
Well, that concludes our session for today. Thank you very much for listening.